Hello, Mavericks. How's it going? Nice to see you. This is Rob Reinhold. I joined by Ankit Sharma, and here we are. This is Currency Room, October 9th. We are already into October. Cannot believe it. And we continue just to have phenomenal trading weeks. That being said, this last week was fairly difficult in the fact that we didn't get 1 or 2 or 3 day trends. We got like 12-hour trends. And so if you were looking to be on that longer end of the time frame of trading, things got chopped up quite a bit. So anyone who was trading fairly short term, it was a great week. Anyone longer term, I know that's usually how I trade, and I took 2 trades this week and lost on both of them. They were both the right trade. They were both going the right way, but in the end just didn't have enough time and length of trend for things to get extended. So let's go through what happened last week. We saw big bounces in the equity markets on Monday, Tuesday, actually 6% in 2 days. It was a huge rally. And then you know what? It gives it all back up. And we still closed up for the week, but not very much. We are closing on Friday at the high of the volatility index. We're right around 32. This is where we've seen there be bottoms. We talked last week about how we weren't getting true bottoming action at a VIX of 32, and we think we're going to have another leg down. We said that last week, and this week we were totally wrong. The Monday-Tuesday bounce was huge. We expected the breakdown to happen last week. It did not. Here we are on Friday. We're the exact same place. We are back to where yields were last Friday. We're back to where volatility was last Friday. And oil is much, much higher than it was last Friday. Oil had the biggest week since February of this year. And we have dollar going back to its highs. So everything we had last Friday, we're there again. We're there again. Actually, it's worse because of oil. If you didn't hear the news, OPEC actually announced a 2 million barrel a day cut from their production. In this time when we already have high oil prices, this caused oil to go from 78 all the way back up to 90. And so the news is not great because inflation is the worry. So let's take a look at what happened last week. On Monday, we got some CPI news from Swiss franc, and the Swiss franc was fairly flat this week, didn't really react. We got the ISM number from the US. It was much weaker than expected, and this is what started the rally. Remember, last week we said good news is bad news and bad news is good news. Bad news is good news because if we get bad economic data out of the US, it means that the Fed is going to back off. It means rates will come down. It means the dollar will come down. And that's really positive for equities. Good news is bad news in the fact that if things are really good, it's going to cause the Fed to be more aggressive. So this poor ISM number on Monday actually caused a 6% rally because people thought, oh, the economy is slowing down. On Monday night, we heard from the RBA. They surprisingly only raised rates by 25 basis points. This was a big surprise. The Aussie was put under pressure right after that announcement. On Tuesday, we heard from the RBNZ, and the RBNZ came through as expected with a 50 basis point rise to 3.5%. Not a lot of movement in the Kiwi after that. So the first 3 days of the week, again, that bad ISM number, the market rallied Monday, Tuesday. The markets tried to sell off on Wednesday, and then equities rebounded, and by the end of the day, were positive. Thursday was a little bit of a down day, and then we go into Friday, and we get a strong employment report. Remember, good news is bad news, and that's exactly what happened. The jobs report came out, supposed to be 250,000 new jobs. It was a little bit stronger, 263. That's not a big deal. What is a big deal, the unemployment rate dropped from 3.7 to 3.5. Fed Chairman Powell said that the Fed is trying to get that to 4.5%. It's going the wrong way. It just went lower. They want it to go higher, up to 4.5%. It means they're going to be more aggressive. So the market sold off close to 3% on Friday. So let's take a look at all the charts, and let's take a look at where we are. And you can see that even though we had a really nasty day on Friday, we still had a positive return on the week, S&P up about 1.5%. But remember, on Tuesday, it was up 6%. So we gave back a big chunk of that. Cryptos had a nice week. Gold had a week, and look at oil. Holy cow. 16%. That is a huge, huge jump in oil, all thanks to OPEC. And basically, they got exactly what they wanted. Let's announce a cut and drive the prices back up into the 90s. So let's take a look at the S&P chart. You can see the big bounce we had on Monday, and then we ran right up to this 20-period moving average, and that's where we hit our head. And we tried for a day or two to get above it and just couldn't. And then this really nasty candle on Friday, closing at the lows. Remember, whenever we see candles like this, when something closes at the lows, it typically means that there's still more selling and at least the next day is going to be lower. Typically what happens. Now look, we closed on our low last Friday and we actually opened up higher. I don't know what's going to happen over the weekend, but I think we are moving lower. Anka, what do you think about the next move in equities?
Well, Rob, based on where the markets are, I think there's more downside pressure or than the than the upside potential here. So again, I think where we are, if you look at the candlestick today, I mean, we are almost there's no sort of tail whatsoever on that candle. So these are very strong momentum candles. I mean, we saw the same thing as we were going up. We got these full body candles with very little wicks. So I mean, right now, as you can see, how did those candles ended? It ended with a gap higher. Now, if we just stay on the lows over here, I wouldn't be surprised if we gap a little bit lower next week. So I think ultimately, we are testing that October lows that we set up on. And I think after that, we'll have to kind of wait and see if this is a confirmed breakout or do we bounce from there. I think next week we could see two part of the week. Again, next week we have this pressure going into next week, but we have the very important CPI, which can, again, amplify this move or can really provide a turnaround because exactly what we saw early September when we got that surprise uptick in the inflation. If we get a surprise downtick, I think we can change things around. But again, momentum. Right now, the sentiment going into it is very bearish. So I think we'll probably stay bearish until Thursday, and we'll see which way it goes with that October lows in sight.
And we talked about this earlier, and we talked about how, the market is going into the weekend with a lot of momentum. So we probably have a down day or two ahead of us. So this is 35.80, 35.85, I believe, is the low we just set last week. Anka and I both think that we trade down to that level. And on Wednesday, when the CPI report comes out, we're literally at this level to where either one of two things happen. Bad CPI report or good CPI report, lower than expected, causes a pretty nice rally. And we could easily go back up to where we were or back up to the 20-period moving average. It could be a very sizable rally of 3 or 4%. Or we're right at support. We get a bad number and the market breaks down hard. And then all of a sudden, we're looking at the next level of support is back to the February 2020 highs before COVID, which was right around 3,300. So that's another 6, 7, 8% down. We'll see what happens. Again, we always are talking with our traders, sending out videos, making sure everyone knows where we stand. But that's where we're looking at right now. We definitely are bearish heading into the beginning of next week. We take a look at performances. Performances this week, the Canadian dollar did nothing all week. Absolutely nothing all week. And then on Friday, the jobs number there gave it a boost. So if you take a look at this, you can say, oh, the CAD was the best performer. It wasn't. It was the best performer Friday. And so what we see here is that there were a lot of these currencies that were up big during the week and then sold off at the last part of the week. Or currencies that were down big at the first part of the week and then rose at the second part of the week, to where we basically look at the weekly numbers and say, oh, everything was pretty flat. That's not true. Things were up big and down big this week. And as I said, there were a couple of currencies like the pound. The pound had a couple 2% moves, one up, one down, one up, and then one down. It's just a lot of volatility. So I think we're probably going to see that until we get the CPI report. And then the CPI report will probably make things trend a little bit better on a longer term basis. Again, it shows that the dollar only up 0.1%. It was down really big the first 2 days. And then it climbed back the last 3 and actually looks really nice. We'll take a look at the chart here. Same with the Kiwi. Kiwi looked horrible the first of the week, and it actually backed off and closed a little bit up for the week. Now, surprisingly, crypto's had another great week. This is the third up week in crypto. Yes, they're off their highs. They took a hit on Friday as well, but not that much. When the equity markets were off 3% on Friday, we had Bitcoin down 2%, Ethereum down 1%, Litecoin down 1%. These things are showing me that they don't want to go down as much as the market. Let's go back to where we were in May and June of this year. The market was going lower, but cryptos were crumbling. Markets would go down 3%, cryptos would go down 10%. This is actually a really good sign for cryptos. Look, I'm not saying get bullish cryptos. I'm not saying they're not going down. I think they're going down with all the rest. But when you see that something goes down less than everything else, it tells you when the risk on comes back in the market that that's where the money has been going. So I am actually quite positive on cryptos. I do not want to buy them yet. But when the bounce does come, I think cryptos are going to be a really good trade off the bottom. We already took a look at the S&P, and we had moved to a -2 because we had rallied up to the 20-period moving average. We're back down. We are -3. We are the most bearish that you are allowed to get in your trading here. Let's take a look at the world index. We can see the same thing with the world index. We are looking to come back down to those lows that we just set last week. So that's roughly 1.3 points on an $80. So again, that's about 1.5%. We got about 1.5%. We think we're going to be there by Wednesday, and then that CPI is either going to make everything bounce or make it fall apart. If we go over to the cryptos, you can see the cryptos, while again, they've been holding in, when you take a look at them on a chart, you can't be super bullish on it. And this is why I'm saying I'm not super bullish. If we compare this to the equity market, it looks much, much better than the equity market. The equity market is making new lows. We haven't made a new low since September 20th. That's really good compared to the rest of the market. That being said, we just rallied up to the top of the range. We hit our head on it, and we're coming down. I don't expect cryptos to go up. We probably come back down to the bottom of the range, and depending on how bearish the market is, it could easily break that range. As I said earlier, cryptos are outperforming, but when everything is going down 5-6% and something only goes down 3%, that's still outperforming, but it doesn't make it a good buy. I just want to make sure everybody understands what I'm saying on cryptos. When the bounce does come, this is going to be one of the first places I look in the cryptos because they've held up the best. Let's take a look at what is happening next week. And really, there's little stuff here and there, retail sales out of the US, GDP out of the UK. Guess what? None of that matters. The CPI. We get the PPI Wednesday, we get the CPI on Thursday. So we think by Wednesday, the markets have headed down to that support line. And then that CPI is going to determine everything. If the number is hotter than expected, interest rates move higher, dollar moves higher, equities move lower. That's the story. If the number is as expected, I think even as expected is going to be seen as good news. As expected or lower than expected, I think this market rallies. And I think we could have a 3 to 4% equity rally. Dollar sells off, US yields sell off, risk assets like the Aussie Kiwi get a bid. So as Anka said, this is going to be a market or a week of two markets. We're going to have the market before the CPI, and then we're going to have the market after. I think you've got to compartmentalize that in your head and say, hey, I'm looking at trades specifically Monday through Wednesday because of this. And then on Thursday to Friday, I'm going to throw that out and just trade the new price action we're seeing off of that.
Absolutely. I'm very open to that outlook. And again, looking back in September, I mean, just to look at the last playbook, markets were running ahead and we had a pretty bullish rally in the first part of the month. And then after CPI, everything collapsed. I think we can see it play around the other way as well. So markets are very, have a short-term memory. They're reacting to what's really coming out with these numbers. And again, this week was a good example. When we got these numbers of services PMI and we had Joel's number, markets were reacting both ways. So this is again telling us that market actually can go both ways. I mean, it's not a one-sided trade on the news. I think if the news is positive, then we can collapse in the markets. And then on the other way around, if the numbers are backing off, then we can actually see the other thing around. So I think we could see a reaction both ways, and risk to reward just makes a lot of sense to kind of trade on that. Regardless of what the outcome is, I think both ways it will create a good opportunity.
Totally agree. Totally agree that we be flexible, especially when that CPI report comes out. Right, let's jump into each currency and take a look at the technicals here. We're going to start with cryptos. I'm going to blow through these pretty quick because as a whole, I don't love them. And you're going to see they're all at like -1, -2. So, we've got a -1 trend score. We got Bitcoin. It ran up to its 50-period moving average. It's hit its head on it. It's coming down. But look, we're not as close to lows as we are in equities. The short-term velocity score is -2. It says, hey, it's having some decent amount of selling right here, right now. But as far as the trend goes, there's not a big range here. Here's Bitcoin Cash, same thing. We're not seeing a huge range. So whenever we don't see a big range, we look for things that are actually moving. The range here on Ethereum, even tighter than everything else. Look how tight this range is. So look, it's a -2. But until it breaks below the bottom of that range, we're not really interested in going short on this thing either. So if we go over to Litecoin, same thing. We're just sitting in that range. Until we get out of these ranges, we just can't be all that excited about trading them, especially, looking to trade something and hold it for a couple of days to a couple of weeks. It just doesn't make any sense here at this point. So let's take a look into Forex and see if we can find things that are actually trending. And hello, dollar. We are finding something right away. So this little move here, and I talked about that this morning when we were talking about our live trading session, the bull flag. The bull flag pattern where you have a big run up, one move, and then you have this really, really narrow, not very steep downtrend, and then you break out to the upside. We do need to clear out of resistance up here, but we are right there. This is looking really good. And take a look at the short-term velocity. We had that big move, and then we're basing up against resistance. Everything to me looks good here on dollar. So I'm starting the week off long dollar. I'm looking against trades against that long dollar. Now the yen has been a no trade for me for a while. And it really is, once we bottomed out back here, we recovered, we came back down, we just fell right in between the moving averages. My rule is when something is between the two moving averages, it's a no trade. I don't trade it. However, we can see that the yen is kind of doing a little bit of what the dollar is doing. And I'm actually open to looking at some bullish trades later in the week on yen. Not early in the week because, look, we haven't really cleared out all that much. The velocity isn't all that steep. I come down here to our velocity score, and we can see it's just sideways. I'm not ready to go long yet on yen. And I can't believe I'm saying this because we have been very bearish on the yen all year long. But this is one of the few times this year that the yen is actually technically giving us a tiny bit of a buy signal. Not ready yet, but I'm willing to look at it later in the week. Swiss franc on a daily chart actually looks okay. We did make a new high. We made a new high. We ran up, we based, we broke out, we came back down. Okay, it's not the prettiest chart ever. It's not as pretty as the dollar. We're getting this really, really lousy bounce off this. So for me, I'm looking at this saying, okay, we had a break out up here. We had a break down here, but 90% of the candles are still inside of this range. I'm just going to consider that the Swiss franc is in a range and look at this velocity score. You want to talk about a frustrating trade? Anyone who's been trading Swiss franc, this is a very frustrating trade because it's not going anywhere. It is literally not going anywhere. So we only want to trade things that are going places that have momentum and velocity. If they're not, we just put them on the shelf. So Swiss franc is on the shelf. Last week on the Currency Room, we talked about how Euro was surprisingly looking like a buy. And look, I could write an essay on all the reasons why Europe is terrible and Europe is the euro is likely going lower. But when I look at the chart and the price action, it says, hey, dummy, look at what's happening. Don't think you're intellectually superior to the market, because if you do and you try to go short euro, the market's going to make you look really dumb. So ultimately, we're in an uptrend in euro. And I have to take a look at euro on the long side only, not the short side. As you can see here, we don't have any momentum going on here. So we're at a -1 on the velocity score, +2. Once this euro can find its bottom, move up, maybe even break out, I'll take a look at a long euro trade, but it is not going to be a trade that I'm looking at the first of the week. This is something that's going to have to develop and show me that it wants to actually bounce here. All right, and here's the pound. Now, I told you the pound had really two moves this week. First of the week, Sunday, Monday, Tuesday, in the second part of the week, Wednesday, Thursday, Friday. As you can see, we're basically back to where we started the week. We did poke our head out above moving averages. That's the first sign that maybe the trend has changed. But all the other signs we need to see is we need to see a few things. We need to see the 20-period moving average cross above the 50. That hasn't happened yet. We need to see this price recover and be trading above the 20 and 50. That's not what's happening right now. So for me, the pound is in the early stages of a potential long-term bottom. But until we get a confirmation, it's too early to do it. I don't want to be short pound because, again, it's shown us that, hey, it had this nice little bounce. I just don't want to be long here either. So I'm waiting for the pound to show me something more, probably at least a week or two before it's tradable in my book. We talked about the CAD. We talked about how the CAD had a big jump on Friday, but look, the jump Friday didn't put it anywhere different. Technically speaking, whatever happened on Friday doesn't matter. So yes, it had the most velocity on Friday. It is ending the week with the most velocity of any of the currencies. But guess what? The fact that it didn't clear out of any range, I can't trade it. I just cannot trade CAD here until it shows me something on a breakout of a range. So that leaves us with Aussie Kiwi. And Aussie has been perennial weak, really for months. And I love this price action. I just love this price action. We took a big fall, we tumbled, and we've just been doing smaller and smaller bounces, a descending triangle. One of my favorite patterns. What happens is, imagine you drop a bouncy ball and it hits a table, it bounces a little bit less, bounces a little bit less, and then eventually it falls off the end of the table. It's looking like that's what the Aussie is setting up to do. We've got major support here on the basket. I think Aussie is absolutely shortable at the first part of next week. So we like dollar on the long side and we like Aussie on the short side. And we come over here to Kiwi, and I gotta say, Kiwi looks good on the short side too. We had a big fall, and after a big fall, what you like to see is a low base. A low base is the weakest of the bounces, where it can't even put it together a nice bounce up to a moving average or something like that, where it just literally just chops around. Here we are right at the bottom of the range. I don't see any reason why the Kiwi doesn't break lower here. So we like Aussie Kiwi to the short side. Ankit, what do you think about those two currencies going lower? I know a lot of people say, hey, they've already had a big fall, but can they go lower here?
I think, just to kind of comment on like something that's already gone lower, I think pound is a great example where, you can see things under pressure, and until something capitulates, it doesn't really set up a bottom. And I think that's where we are. They're slowly grinding lower. I mean, we saw that big move in Kiwi early this week, and that was pretty encouraging. And here we are almost trying to give back those gains. It's just telling me that the bottom is not in yet, or we just need to kind of see the market recover for really any of these currencies to recover. So as long as the market stays weak, it seems like any of these rallies are just going to be sold off. So correlation, there are times their correlation just not work. We have seen that early this year, like back in February, markets were kind of going down and we had Aussie Kiwi going up. So, the correlation wasn't really working at that time. But right now, there's a very spot-on correlation. And if you look at the historical range this week, Aussie dollar, Kiwi dollar, I mean, they were trading in a 2% range because the markets were flip-flopping, and so were these currencies. So I think right now you just have to really put together this correlation and then kind of see which way market goes. And if the market continues to go down, I think we'll probably see these currencies go down as well. And same thing with the dollar. If the dollar needs to kind of back off, then we need to see the market start to bottom out as well. So I personally think that even though something looks like it has a big move, maybe it's not maybe it looks extended to sell, but I don't think it's ready to be bought yet. So we have to wait for the right conditions if you're looking for market to kind of recover or go higher. But for now, I think it's a difficult trade.
And Anka, what you said was just so wise because if you think about what we saw in the pound had been going lower and lower and lower, and everyone said it can't go any lower. Is it actually going to go to parity with the dollar? It just kept falling. And then over the weekend, the new prime minister announced a tax cut deal. The pound got slaughtered. And then the Bank of England came in and said, we'll start defending the bond market. That is the kind of action and situation Anka was talking about. That until we see something like that, until we see something that dramatic, these things tend to grind lower. And then once we do see that big dramatic fall, let's say that we do get Aussie Kiwi fall 4%. Okay, then I think you can start to say, okay, now it's actually probably closer to a bottom. But when they just grind lower 0.5%, 1% every day, it tells you it's likely going to go much further until we get that capitulation. So the trend scoring says, look, dollar Kiwi, dollar Aussie, that's what we're looking at. The velocity score says dollar Aussie, dollar Kiwi. So they're in agreement here, looking at just those two pairs at the first of the week. So there's not a whole lot to look at. So let's take a look at those pairs, Aussie dollar, Kiwi dollar, and see if we can identify any potential setup points. My favorite is Kiwi dollar. And if we take a look at it again on a daily chart, it is just a really nice low base. Just a really nice low base. And we just broke through the parabolic SAR here on a daily chart. So that's just a great little signal that we are going to break below the low of this. The big question is, okay, where's the entry? Where's the entry? And I think we can see pretty clearly the entry is a break below 55.90. 55.90, you could go down to maybe 55.75, somewhere in this area. That's going to be the entry price. And then, of course, get your stop based on your time frame that you're looking. If you're looking to be in a couple of days, you're going to have a much wider stop. You might be all the way up to 57. So again, use your stops accordingly. But to me, this is just a great, great setup. We've been low basing for over a week, closer to 2 weeks here, gathering some momentum for the next leg down. Take a look at Aussie dollar. Aussie dollar is really doing the same thing. And you can see that the Aussie is a little bit further along. We are literally breaking the lows right here at the moment. I think Aussie dollar is ready to go. I think if anyone said, hey, I want to take a short over the weekend, great. I think it's a great trade. I think it's got some decent risk reward to it. If you don't like holding over a weekend, just look to get in early here off of this move. But Aussie dollar looks great. Okay, what else are you looking at?
Hey, Rob. Well, as we take a look at a lot of these dollar crosses, I mean, they are either broken down or they're ready to break. So I think at this point, we just have to find out where is the movement. I mean, the Aussie actually looks better to me than Kiwi, Rob. I know Aussie Kiwi has been a pretty tricky play this week because if you take a look at Aussie Kiwi, I mean, early this week, the RBA decided to cut much lower than what they, raised much lower than they were expected. So, I mean, initially Aussie took a hit and then we have seen the Aussie recovery, but I'm not really buying that. I think there could be a further more weakness in the Aussie compared to the Kiwi because now we are seeing the Aussie or the RBA pivoting a little bit earlier, but the RBNZ is staying on course of raising rates. So I think there's a bit of a change there that I'm kind of watching. So Aussie Kiwi right now in the short term looks okay, but I think Aussie dollar looks pretty good. Rob, I want to point out a couple of pairs that outside of the Aussie and the Kiwi. Dollar Swiss franc. I know Swiss franc didn't do much, and again, we're just talking about where's the next big move and opportunity. I mean, look at that thing on a daily chart, just slowly coiling higher. I mean, we have seen things break out. I mean, this thing hasn't really broken out since May. I mean, I like the fact that we are slowly pushing that envelope there, and I know the Swiss franc has been not taking a big part this week, but I mean, just early this week, Swiss franc got hammered on a Monday. I mean, that was 1.5% move. So, I mean, if we get another move like that, and you can see that this is just sitting right below parity level, I think this could be something that just play out the relative center weakness compared to the Aussie, which is more sensitive to what the market's going to do. I think this is something that is setting up very nicely here, and it has a nice little range for this to kind of catch on to. So I think a lot of if we just go with the chart, a lot of the dollar crosses are looking the same. And if you just take a look at the other places too, like euro dollar, we had a nice little rally. But Rob, I just want to point out another pairing that, we just want to make sure we look at is euro versus franc, because, we have seen the euro actually being worse than Swiss franc. And then lately, I mean, we had a nice little rally there. So, I mean, the outlook for euro, I mean, I like euro a little bit much better right now compared to the Swiss franc, because again, technically, this thing does not look that horrible as it did early or late last month. So, I mean, if this is just it's just a pullback to buy into, I think it's a clear signal which one to buy and which one to sell. And I mean, lately we have been net long this Swiss franc. I mean, if that comes to a change, we'll see that in euro Swiss franc, and I think that's where dollar Swiss franc seems like a better play to me compared to the euro dollar. But again, that's just relative trend of weakness that we are talking about here. Another thing, Rob, if you want to pull up dollar basket, and I just want to talk about the correlation right now. And I really like when things are really setting up nicely. And if you're able to take a look at 2-year yields for the U.S. and just add that into the chart here, we'll see how correlated that is. And I think this is where, if you're trying to find out where the move is, I think you just follow the yields. I mean, 2-year yields have been very spot on. And if the yields breaks out higher, I think doesn't matter if you think the dollar looks extended, I think your dollar will continue moving higher. If the yields pull back, I think the dollar will pull back. So far, we're seeing a very good sort of guide for the U.S. dollar. So, I mean, you can see that we are looking exactly where we are, trying to break out on the yields, and we're trying to break out on the dollar as well. So again, keep a close eye on this one, because this is where it's giving you a bit of a guide on where the dollar will go. And I think this is something that on a CPI report, something to watch out for, because if the yields shoot up, I think the dollar that would be a catalyst for dollar to go higher. If the yields fall, I think the dollar will then pull back as well. So just wanted to kind of point out that correlation there, and using that into our favor as far as a leading indicator goes. But I think next week will be a great week. I'm very open to both case scenarios. But again, right now, very negative momentum, but that could shift late next week as well. So I think overall, one of the things that I've talked about is the ranges. The ranges have gone up quite a bit. Rob, if you want to put up Aussie dollar just for an example there, this thing has gone up about that's a 2% range. I mean, we don't really get this. I mean, last time we got this range was back in May. I mean, and I think before that it was a COVID time. I mean, this is a very wide range. So if you're trading around this time, you just got to understand that things are moving quite in a movement here where you just need to give yourself more wiggle room. Volatility is high, which means that it's very easy to get your stops taken out. So make sure that you give yourself enough wiggle room for volatility instead of just going with a standard 30 pips. I think right now you just look at the ATR, things are just widening up. So you just have to give yourself a little bit more wiggle room for your position to develop. And again, looking at this chart, it's hard to get behind a move, like either it's a downside or an upside, which means that, we can't just put on a trade and expect that to be going in one way, for in a week. This is a very short-term trading environment, and things can move very fast one way or the other. So making sure that you're using the right time frame, right expectation for these market conditions. Again, when things calm down, I would love to go on a 4-hour chart and let the position develop for a little bit longer. But right now, I think the only way to really have good trades is when you are looking at shorter term and you're just getting behind the momentum. And that will, again, give you a decent risk to reward as well. But if you go on a higher time frame, your risk to reward is going to be really wide in terms of the ranges that you're dealing with. So that's all I got for now.
Great analysis, Ankit. Let's wrap this up. So we think that the market drifts lower the first couple of days, and then that CPI report it is going to rip higher or rip lower. Which one, we don't know. So we're going to make our trades based on a risk-off move Monday through Wednesday. We're going to sit there in cash, watch the CPI develop, and then we'll take some trades after that. I think there's one more flush down in this market. Remember, back in August, we warned everybody that September and the first 2 weeks of October are the worst 6 months of the year historically for stock market returns. They're the worst. The most crashes have happened in this period of time. We're getting to the end of that period of time. So I think we get another flush lower. I think we get a big panic. I think we go down to February 2022 lows, but I think that's where we do find a bottom. But we'll have to see. We're always open to new information. If it looks like that's not the bottom, then we'll stay on the short side. But until then, we'll just simply go with what we're seeing now, which is looking like we're going to head a little bit lower. Thanks for joining us, everyone. Have a great weekend. Take care. Stay safe. Goodbye, everybody.